focus and shift our attention to an exclusive conversation now. Niva Bupa Health, in their first television interview since listing, they have told CNBC TV18 they're expecting higher than industry growth for the coming fiscal. Yash Jain spoke to Mr. Krishnan Ramachandran, the MD and CEO of Niva Bupa Health, to talk about the health insurance sector and the business momentum that they foresee. Let's listen in to that conversation.
So on a full year basis, as of H1, the health insurance industry grew at about 17-18%. On a full year basis as well, is that our expectation that the industry on a like-to-like basis will continue to grow at 17-18%. Our H1 growth was about 32-33%, on a like-to-like basis. And by the time the year is done, you can continue to expect us to grow I'd say 8 to 10 points, at least faster than industry on a like-to-like basis.
By FY25, which means accommodating for the second half, are these two numbers possible? I am just going by how you've grown in the recent past and normalizing it. 5,000 to about 5,200 crore as far as NEP is concerned, and about 6,300 to 6,500 crore on the GWP side.
See, on a like-to-like basis, our GWP number would be upwards of 7,000 crores, Yash.
Okay.
We did 5,600 crores last year. As far as GWP is concerned, on the same accounting basis, our GWP for the full year should be upwards of 7,000 crores.
At what point, in your sense, does growth start aligning with the industry? At what number do you think that the size is good enough for the growth to start aligning to the industry, according to you?
I'd say in terms of growth aligning towards industry, that number is probably when we get to upwards of 15,000 crores, Yash.
Okay.
I think at that point you can start to expect us to grow. Even then, I would wager that we'd probably grow faster than industry, but if you have to sort of put a number to it, it would be upwards of 15,000 crores.
Slightly longer term view, 10,000 crore of GWP in the next 2 years and 10,000 crore of NEP in the next 3 financial years, possible?
10,000 crores in the next 2 years, plus minus 5% possible.
So one question as far as expenses of management is concerned. At the end of H1 FY25, that stood at about 40%. We all know that the regulatory compliance requires you to bring it down to 35%. I believe you've put in a request with IRDAI to give you some time to comply with that. What is that time limit that you've sought from IRDAI?
What I can confirm, again, on a like-to-like basis, is that by FY26, we are on the path to compliance. Obviously, there's a change in terms of the accounting. So we have submitted our position to the regulator that there has to be an adjustment for the accounting change. But on a like-to-like basis, we are on the path to complying by FY26.
FY26, the expenses of management comes down from 40 to 35%, as you stated. That 5% of reduction in the expenses of management ratio, how would that translate in terms of quantification on the combined ratio?
Got it. So let me, so as of FY24, our expense of management ratio, Yash, was 39.1. And there was about roughly, if you look back at the last 3 years, there's been a 200 basis point improvements, 150 to 200 basis point improvement year on year. So FY26 as a standalone company, the expense of management limit for us will be 35% plus allowances for InsurTech expenses for, incremental rural business. From 39, which was last financial year, we need to come down to, let me say, 36. Steady state basis, and I'm not saying that we'll get to this combined ratio next year. On Indian GAAP, as it stands today, again, we need to work our heads around the accounting. Steady state, you can expect a combined ratio between 95 and 96%.
What do you expect for FY25 as far as combined ratio is concerned? What would be the target? And FY26 and FY27, is there any target internally within the company in terms of how much ideally do you want to reduce combined ratios each year?
So Yash, for this financial year, as far as this financial, last year we were at 99% combined. And last year we had a higher level of seasonal infection, so the claims ratios were higher than the previous year. One of the big reasons was a high level of seasonal infections. This year, we've had seasonal infections, but it's been relatively muted compared to last year. So we do expect our combined ratios to fall well below 98% by the time this financial year is done. And as I stated, the journey to a 95% combined ratios is over the next 3 years, we should get to a 95% combined ratio on an Indian GAAP basis.
About 95% of the shareholding of the company is with institutions. These are FIIs, DIIs, and Bupa Singapore and Fettletone put together. There was, of course, the lock-in, which opened for 50% very recently. If you could give the street some idea in terms of which were the anchor investors, which sort of tendered their shares as far as that lock-in was concerned, and particularly with Bupa Singapore and Fettletone. Currently, Bupa holds about 55.98%. Fettletone owns about 17.47%. What is the kind of stake that they want to keep over the next 2 years, and how much do they want to divest and value unlock in the market?
Sure. In terms of Bupa, it's a simple question, Yash. Bupa is a very long-term shareholder. Bupa may increase shareholding from where they are over time, but they do not intend to bring down shareholding below the 56% that they already are at. As far as Fettletone is concerned, they are private equity. So over the next 2 to 3 years, again, they are not in any rush. They are a long-term shareholder, but over the next 2 to 3 years, you can expect the 17.5% to come into play, into the market. So that's as far as the Fettletone is concerned. In terms of the book is concerned, yes, we do have very high quality names in the book. To your specific question on, has any anchor, I don't believe so. We don't have the data yet. We get the reports, 2 days after. But if I just look at today's trading volume and value, I don't believe there's been any sale from any of our anchors.
The group of ministers recommending largely 3 suggestions when it comes to GST on health insurance. One is complete exempt for senior citizens. The second one is complete exempt for sum assured under 5 lakhs. And the third one being bringing it down to 18% to 5% for non-senior citizens. I just want to understand from you, what are your expectations in terms of what could be the final structure that could come through in terms of a combination of these 3? And would you be able to pass on the entire benefit to the eventual policyholder in terms of that mark-to-market cut which comes through?
Yeah. So Yash, the recommendation from the industry and my strong recommendation on 2 grounds, right? From an affordability standpoint, 5% does serve an affordability objective. Exemption does not serve the objective of bringing down prices because it means that we do not get credit for inputs. So effectively, exemption means that it actually increases costs from our standpoint. So really the recommendation or the suggestion from our side is to bring it down to a 5%. Straight away, that's 18% coming down to 5% is a straight saving. The sticker price comes down to that extent across the board. And it's also, a lot simpler from the point of view of execution. So my strong recommendation would be to not look at exemption because that will actually increase cost, which is contrary to the purpose of, the discussion around GST.
Interesting times then for the insurance space. I'll tell you what, let's slip into a short break. But on the other side, we have Sudeep Shah and Mitesh Thakur who are joining in for a technical check on the markets. Stay with us.